Hello and welcome back to another episode of the Investor Financing Podcast. Today's show, we have a great guest. We're going to be talking about San Diego, my favorite city in all of California. We're going to be talking about buying rental properties. We're going to be talking about the gentleman's career, dating back to 1998 in real estate. He's a property manager, real estate broker. And most of his clients are all, investors, and maybe some of them are larger, some of them are mom and pop type investors. So we're going to dive into real estate in California, and please welcome founder and principal of Income Property Advisors Inc., Robert MacGuire. He's been involved in property management, marketing, and sales of residential income and commercial properties in San Diego and Santa Barbara County since 1998. His specialty is residential income property management and representing buyers and sellers in the purchase of these properties. Welcome to the show. Thanks for joining us.
Hey, Bo. Thanks for having me.
Yeah. So you cut your teeth in sales, really. Did you just jump into investment sales in your career, like starting in 1998?
Well, so you asked for a bio. So I sent you a bio that. So I don't want to date myself, but I graduated from high school in 1988. So I've been in real estate for 30 years. I started my career as a retail broker, actually, for a company that's no longer around, a commercial real estate company called Grubb & Ellis. Mm-hmm. And so I grew up I was born in California, in a native of California, born in Marin County, which is Northern California, outside San Francisco, across the Golden Gate Bridge. And then ended up, my dad was transferred for work, so ended up in Colorado, lived and went to school and went through all my schooling years in Colorado, and then started my career in Colorado, and then moved to Santa Barbara in the 90s and moved out there for a different business, ran that for a couple of years, ended up selling that, and got back into real estate. And was always interested in, when I was a retail broker, I liked retail, and I still understand and still follow the retail market, actually. But I was always more interested in the apartment world, and I liked the apartment brokerage. I liked the apartment guys in my office, and so it always intrigued me. So that gave me a chance I kind of went through a pause in my career in retail and didn't want to start retail in a different market. And so it gave me an opportunity to take time to learn and understand that asset class. And so in the late 90s, that's when I started doing apartments and residential income.
Nice. Very, very good. Our market, as you know, is just like absolutely blown up. Prices are at all-time high. Everything's compressed. We're now seeing a change in the market. We're seeing high inflation. What's your crystal ball say that's going to be occurring over the next 12 to 18 months? Do you see just a kind of just a slowdown, or do you see maybe a decline in prices?
So, Bo, so is this a question? Are you thinking are you asking specifically about California, or what am I seeing across the United States? Because we run an investment platform as well, and we have done some private equity investing, and so we're investing in the Southeast, where I'm currently, literally when I get done with this call, I'm going to be a limited partner investor in an apartment building in Florida, and so we do a lot of that as well. We also do a lot of 1031 exchange and place money. So if it's a national question, I look at real estate much like you do. You and I were talking offline before this, and you were talking about San Diego and how much you love it. And I have a friend that lives in Nevada, in Las Vegas, and is in the casino business, a friend of mine back from college. And, I was out there for a birthday party not too long ago and talking about that market, and know how much that market has blown up. And obviously in California, because we see the same thing that you do, our cap rates are very compressed. Our market, it's very, well, there's two things. One, we have major competition for our, any kind of good investment real estate that comes to the market. it's a very competitive. And the cap rates are so compressed that a lot of people do look to states like Nevada, Phoenix, Colorado, places like that. So we've been part of that. So my local market, to answer your question, what I see is for us, so we have a different market here in San Diego. If you've been following California, let's say over the last 10 years, San Francisco and Los Angeles have all had just huge run-ups in rent and pricing. But San Diego always lagged. And so San Diego is now starting to catch up. And now San Diego, in my opinion, is one of the hottest markets in California for a number of different reasons. One, we have supply constraints, and so housing is at a premium, so rents are at an all-time high. The negative is that we have very heavy-handed rent control laws in the state of California and in our city and in different cities within our city, which makes it very challenging for an outside investor to come in and understand how the mechanics of this market work, because every city can be different with little nuances in rent control and things that affect landlords. So that's important to know if you're looking at our market. And then the other piece is that, I think probably since you've been coming to San Diego, you've always probably noticed the military presence here in the Navy. And when anyone thinks that, Top Gun just came out and San Diego's all over that movie. So if you've seen that, you've seen San Diego. And, so the Navy has had a big presence here. But in the background, we have a big economy, but it's always been shadowed by San Francisco and LA. So what's happening now is a lot of these big companies have relocated into San Diego and are expanding into San Diego. And so we're seeing a much more diversified economy, more than we've ever seen in the, 15 years that I've lived here. And in the, almost now going on 25 years that I've been in California, San Diego is really starting to take off. So one of our big industries that is coming here is the biotech industry. So when you ask, what do I see? I definitely see a slowdown because of interest rates, but I see our market weathering it very well. And so if I look at other markets like San Francisco right now is really hit hard because nobody wants to go back to work there because of a lot of the social issues, a lot of the political issues, and it's just a very expensive city. And so people have found that are in the tech world that they can work remotely, and so they no longer have to live in San Francisco. So if you know anything about, cities and raising kids and things like that, it's very expensive. San Francisco has, very small, expensive places. And so that's kind of hard. So if you have the ability to get out, they've gotten out. And I think these tech companies are going to have a hard time getting people back. So I've been reading a lot about San Francisco because we've looked at San Francisco a lot. And obviously I have a lot of friends and families in San Francisco, and I'm in San Francisco all the time. And I look at that market as it's going to take a lot longer than people think for that market to come back. And then LA is kind of its own animal and has equal or if not greater problems because of their supply constraints and, again, the rent control. So you're seeing a real pullback in investing. I network with a lot of brokers. We manage several larger institutional owners in LA, their assets in San Diego, and we talk to them all the time. And, they're very down on that market right now. So I think San Diego is going to be the best market over the next couple of years. The real question is what's going to happen to pricing with interest rates. Right now, we're seeing just an erosion, but we're not seeing anything like, cap rates are not going to 5.5s from the 4 or 4.5s that things sell for right now. We're not seeing cap rates increase, at least not with the way interest rates have increased. And then as far as pricing goes, we are seeing some price reductions, but it's very slow, and they are soft reductions at best. So for example, something that is a couple $1,000,000, you might see someone lower the price, $50,000 or $100,000. And as you know, that doesn't really move the needle that much. So it's going to be interesting. I mean, with rates, I think we're definitely going to see a pause, but I don't think this market I don't think we're going to see some 30% adjustment in San Diego, at least. You might see that in other markets, but not here.
And obviously, you have a pretty large property management company. So, what's the demand when you put a new listing up? Are you pretty much keeping very high occupancy levels across the board?
Oh, it's insane. So that's a really good question, and it's an interesting question because we do have a pretty large platform. We're right at about 1,000 units, and we're growing at a pretty big pace right now. A lot of that is due to the new laws that have been put in place. A lot of the mom and pops, which our market is, probably 90% mom and pop owners. It's small family offices and things like that. We're fortunate enough to manage for a couple of larger family offices, and then we have a whole bunch of different types of owners from syndicator type guys all the way up to what you would say are institutional. And so when I look at our portfolio as a whole, and we just had an asset management meeting yesterday, and looking across a portfolio that we manage of several hundred units in a neighborhood called North Park, our average days from move out to move in that portfolio is 11 days. So that's insane.
That is insane.
So yeah. So, and kudos to our team for turning the units as well as we do. We've got a really crack maintenance team. We've got about 10 guys that handle all of our stuff, and they're awesome, and they do a great job. And so we're turning things really fast. We pre-market, so when we get a 30-day notice, we typically get in touch with the tenant, do a pre-move out inspection. Usually, if we get the 30-day notice, we'll start the pre-move out inspection in that first week of that 30-day notice period. Then we know what we're doing. We put that work order in through our maintenance team, and then our leasing guys start to pre-market it usually around the 15th of the month. So we have multiple applications usually submitted, within the month that the tenant's moving out, and we have it pre-leased, before it ever goes to market. So it really is pretty crazy here. I think our inventory citywide, as far as available units, so our vacancy is less than 3% right now, citywide.
Wow, that's incredible. Yeah. So do you manage any furnished rentals like corporate housing at all? Is anybody transitioning to 30-day stays and longer, where they're kind of gearing for people that are coming for longer-term business, maybe traveling nurses, or is everything pretty much just regular long-term rentals?
So, Bo, we're mostly we are long-term. We're a long-term platform, but we do have a few short-term rentals just because in San Diego, and most of those people are people that I personally know, like friends. But in San Diego, you get a lot of second home buyers, and so they don't use the home year-round. So I have a couple of clients that own some condos in the downtown market that we help them when they come for 6 months out of the year and then go back. And then I have several different beach people that own beach homes that do that for part of the year. But it's not something that we do. We would not consider ourselves a vacation rental company or a short-term rental company, just because we don't have the bandwidth to handle the turns and things like that are required. You really do have to run like a full maid service to do that effectively. It's almost like, it's akin to running a hotel. And so we just stay away from that. But that market is super hot too. But, it's interesting. It's starting to change because I don't know how much. So when you're in Nevada, do you come, it's hot there right now, I'd imagine. Do you come to San Diego like the Arizona people to kind of get out of the heat? Do you come to California to go to the beaches? Is that what you?
Yeah. My brother lives in Orange County too, but I like Orange County, but I prefer to go to San Diego on my weekend vacations for sure. So yeah, definitely.
Yeah, we've got the better beaches, right? And that stretch from Carlsbad to all the way to Coronado it's pretty special. But so it's interesting, so they just changed the short-term rental laws here. So now in the past, you could just, throw your property on Airbnb and you could rent it out short term. And some neighborhoods, there was pushback from people and things like that. But now there's a law, and so you have to do that on a permit basis. And so the permits are now pretty limited. So if you don't have a permit, you can't do it. So that market's going to change. So next year, that's going to be very interesting to see, how that affects this market. We have a lot of big, powerful hotel people in this market, and they were the ones that were part of the lobby for this law. And so, it'll be interesting to see how that affects our market, because there are going to be way less Airbnbs that are going to be available in our market starting next year.
It almost seemed like a lot of investors were kind of jumped the gun and just started buying these properties, expecting what happened over COVID, where it slowed down and all of a sudden there's a boom for these type of properties. Now I'm seeing in a lot of Facebook groups that people like that were buying in the Smoky Mountains and different places all over. Like, there's definitely a noticeable slowdown. I just read a report from AirDNA, which does all the analytics on short-term rentals, and they said that the average occupancy level is like 70% across the board. So I do think we'll see stress there. I think that might be a place, because San Diego is a well-rounded city, but like places like the Smoky Mountains is really just a tourist destination. So I think those places might be the ones that get impacted more so than people are going to San Diego. It's drivable. It's got its own economy. Yeah. It's got a lot of job growth. It's a lot different than like just a destination type of place. So it's
I couldn't agree with you more.
Yeah. Mm-hmm. So did
I
you
couldn't agree with you more?
Did you basically, as you were growing the sales brokerage business for multifamily, you saw the need for property management? Because obviously that's always the big concern with investors, is that it's hard to find a good property manager. Is that kind of how you started your business, out of necessity, basically, from clients?
We did. And so as a broker, I saw it a lot. And part of my career as a retail broker, I worked as an in-house guy for a developer for a short period of time in my career. And so that part of that platform was the property management side. So even though we were leasing a lot of this developer group's properties, there was also third-party stuff that we were doing. We were going out and getting listings and doing that, but it was a much smaller platform than like Grubb & Ellis or the company that I went to, where it was what you would imagine a big brokerage office would be like for commercial real estate. But so to answer your question, I mean, the management thing, you're right. We saw a big need for, when we were doing brokerage, that there was there was just not anybody out there. Most of the managers in the residential income space don't really have an understanding of residential income properties. They understand how to pay the bills. They understand how to generate reports, but they actually don't understand how to run a business plan on real estate. And so because my brokerage background, I understood the economics and the mechanics of real estate, and looking at a rent roll, understanding the loss to lease, understanding where the value add might be, and analyzing anything. And so that I translated that into a management platform, and kind of word got around that, we were more investor centric, and, we started to build a reputation. And over time, we started to attract really great owners, and we've been very fortunate. I have very few small owners. Most all of my owners are investor operator people. And that, for the property management world, makes things a lot easier. If you're dealing with someone that's trying to just rent their house, and that's the only asset they have, there's usually a lot of emotion that's tied to that decision and to that asset. And unfortunately, they usually don't have a deep understanding of kind of the costs of what goes into turns, and how much unit turns cost, and just what to expect from tenants. And in our market, tenants are, they drive everything, and they have a lot of power in our market. And if you're a small residential guy, that can be hard. So I've kind of stayed away from that. We did do it early on because we were building a platform, and we still have some great owners. And I'm not taking anything away from the one-off guy that I still believe in real estate as a great wealth builder, but we're fortunate enough to work with real estate operators. So we would say that we're probably a more dynamic platform than most, because not only are we executing on the operational, the leasing of the property, we're also handling a lot of construction management. We do a lot of the turns in-house. We do a lot of the design on the apartments and make a lot of the core decisions, that the owner kind of sets us free and really lets us run the asset. So if you went, like in your market, if you went to one of your larger buildings, like a broadstone building or an equity residential building where they have an on-site team, our office, although all of our stuff is outside of the city, we kind of run our stuff like an on-site type team. So we all work as a team. We all know pretty much everything about every asset that we have, and so we're kind of executing as the true owner's rep. Like we make owner level decisions up to a certain point that a lot of management companies don't have that latitude. But part of that reason is because we're dealing with investors that entrust us with those decisions. And so we sit down and go through a business plan for the property before we start managing it. And then we meet usually with all of them over the course of the year, either weekly, quarterly, biannually, and we review that business plan and make sure everything's going well. And then they just let us go. So we set the budgets, we do all of that. So we're pretty full service and we're pretty dynamic because we can handle everything. We've renegotiated loans. We've, done a lot of construction management. We've been assigned to do a lot of 1031 work and things like that, where we've even gone and identified assets outside of our market. So we have a lot of those types of owners, and that makes it, a lot more fun.
Yeah, it sounds like you have a great experience level where you're able to help these investor owners, grow their portfolios, and they trust you, and you're basically helping them be pretty passive with their investments because you're overseeing the majority of it. And that's the goal for a lot of these family offices and such, right? They want somebody that's going to just, hey, we don't want to think about it. This market, do what we need to do.
Yeah, I mean, they come in and their idea is, look, so I'll give you an example. So we have a large family office. They own hundreds of units in our market. We manage those, and their game is that they will make the decisions on what they're going to buy and where they're going to buy, and then we meet jointly and decide on usually a business plan together. So, what is it that we're going to do to add value to the real estate? And then how are we going to move the NOI, And so that's where we meet together. So a lot of times, it's a father and son, or it's, a father who oversees and a couple of family members in-house that are kind of out working with the brokerage community. And then as they identify an asset, usually the minute that they go under contract, we are then brought in. So we help with the due diligence. We help with the underwriting. We look at all the different aspects of the real estate. We can poke holes in anything that the broker is saying. That, the broker's opinion of the property is always much different than my opinion of real estate, right? So, and so we have to try and bridge that gap. But we also have to know, do we have a good plan here that we're going to be able to execute on and make this a good investment? And so that's the way that we look at stuff, and that's how we typically work. And those are the things that we get called in for. So it's been good. I mean, we're fortunate to have those types of owners, so it makes it a little different. There are good property management operators out there that do more of the vacation rentals or the beach rentals, or they handle a market like beach rental stuff, but they may not understand the maintenance and the budgeting and the things that go in to really operating an overall real estate portfolio, and the year-over-year things that you have to think about, because they may have a cluster of a lot of one-off stuff where we have, our smallest building is, 5 units and our largest building is 71 units. So we have, large and small properties. And we're kind of in that sweet spot here in San Diego and really in Southern California of the, the buildings that are, a large part of our portfolio are 20 to 40 units. So, those buildings have to be run.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Bo Eckstein, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. So what about, you had mentioned like you had an investor club. Do you syndicate deals yourself as a GP, or mostly at this point in your career, you like to be the LP, and since you have all these connections with a lot of sponsors, you're getting invited to put some money in deals. So how does that look for you?
So we have done more of probably what you're doing in your market. We've done a lot of flipping and things like that in-house, where we've identified, small assets that we've purchased and turned around. We have not done much. The last one that we did, we sold as we got into COVID. I looked back on it, and we probably should have kept it longer because the market went crazy. But at the time, nobody knew, right? And we had just come out and gotten it rented, and we were like, well, man, we better get this thing sold before, we don't know what's going to happen here. And so we sold it at, a market price, and we did fine with it. But so that's the last deal that I did, was probably in late 2020. And so for the last couple of years, the market has gone so crazy, I've just been sitting on the sidelines. So as a GP, we are now going to come back out next year and start our GP platform and fire that back up. We were just getting ready to do that. We ended up taking an LP position in a deal in Macon, Georgia, and a couple of deals in Tennessee and in Florida. We're now expanding into Florida with this syndication group that we work with and some sponsors that are really, really good guys. And we're going to start our own more in the West. So we would be looking at a market like yours, like Nevada. I like Reno a lot and things like that. But for the last couple of years, it's been a kind of a wait and see, But now I feel like there's going to be real buying opportunities, and so I kind of like what's going on in the market right now because, one, I'm a fan of higher interest rates, to be honest with you. I think that's a good thing. I know that this is going to be painful, but I think as time goes on, the higher interest rate is ultimately going to be better for everything. It also gives us another, bullet in our holster, if you will, for future economic issues that could come up. So, if you recall in 2008, when the market melted down, and especially where you are in a place like Nevada, that was catastrophic. And so they used rates at that time to kind of stimulate the economy. In my opinion, this whole rate thing, it probably should have started happening in 2012, but, for whatever reason, be it politics or, whatever economic indicators they saw out there that they didn't want to interrupt it. I think anyone that knew, had been in real estate for a long time, knew that that this day would come at some point. Probably didn't think it was going to come as fast as it has, but it definitely was going to come.
Yeah, I mean, there's a lot of things outside of our control. COVID, the war in Russia and Ukraine, right? Like, there's things that are going to happen over time. I mean, nobody knew we were going to have a pandemic, and I'd never been through a pandemic before.
Me neither.
Yeah, and so it's changed. It's changed a lot. And then, I've been reading articles from Elon Musk, and he's like, you guys need to get back to work. And I think that's going to be the problem, like you were mentioning in San Francisco, places like that, where, people are, I don't know. In my mind, the politics there are a little screwed up. And so people are getting away from those type of places. and they're relocating, right? They're coming to Nevada. They're going to Southern California. They're going to San Diego. They're going to get away from those bigger cities and go to, like, thriving communities like we're in.
100%. I agree with you. I couldn't agree with you more. And that's the thing, people, and I don't want to get political in my discussion here because, whatever. But at the end of the day, politics do affect businesses and economics. And, we're definitely seeing that in California. San Francisco, is what you would consider is, one of the most progressive cities in the country. And look what's happening there with their city attorney, with their attorney general or whatever the city's attorney is, Chesa Boudin. They just had a recall of him, because people in the city are going, I don't want to live here anymore because it doesn't feel safe. Well, you know what? When enough people leave, that will affect the real estate market in that city. It'll affect the city also. You lose revenue, you lose taxes, you don't have businesses, And it's funny because, there's been so much noise about all this stuff, but the long view and the long implications of this type of stuff, it's real. It's like, you start having these problems in a city. San Francisco got the smash and grab things that were going on there got so bad that, like, Walgreens won't open new stores. Think about that. In the United States, that you can't walk into a drugstore, or I have friends up there that are like, some of the drugstores you go in and literally everything is locked. Like, you have to go find a person and say, hey, I want to buy deodorant in aisle 4, and they have to come and unlock it, So those things matter, and that's affecting those cities that have those types of laws and that they have these progressive DAs, and these DAs, they don't prosecute crime, and then businesses bail out of there and people bail out of there. You were talking earlier about the second home market, and I couldn't agree with you more about that. A place like Lake Tahoe, tons of people from San Francisco moved up to Lake Tahoe, and that's the migration out of San Francisco and LA has been heavy. So Lake Tahoe, Santa Barbara has gotten a lot of people from San Francisco because they have the money and can afford to live in that, that city. It's a very expensive city. It's a very Tony town, and it's very high rent, and it's a beautiful place, but it's expensive. And so, you're seeing a lot of the people that have the means from San Francisco and LA move up there, and then San Diego. And so, and people from here that can no longer afford San Diego are heading to where you are. I know a lot of people that have bought places in Nevada and in Phoenix. So there's definitely migration going on.
Yeah, when I looked, I had a townhouse in 2014 I bought here in Las Vegas, and it was like 150 grand. It was a really nice townhouse too, and I was like, 2014. Yeah. Now it's worth or about 300 now.
Yeah.
And then I sold that, and I'm like, all right, I'm going to move full time. And then whenever it was about 3 years ago, I moved here full time. And what I could buy in Henderson, Nevada versus what I could buy in Walnut Creek, California, I bought a 2,600 square foot house for less than $400,000. That same house in Walnut Creek would have been $1.3 million. So it was it was kind of a no-brainer for me because I work remote. I'm in the lending business. I have my own lending company, and so I could do what I wanted. And so people like me, I think, are choosing, and obviously, if it wasn't the money thing, I would have picked probably San Diego. But I'm like, I'd rather just live in a lower cost environment. If money wasn't an issue, it'd definitely be San Diego because that's.
For you though, like you said, you're in a lower, and that's to my point, about like Lake Tahoe and places like that. A lot of people are doing that in those expensive cities, and they're choosing lifestyle over location. And being where you are in Nevada, you and I both know, for those people that are listening today that are not in the West or not located near where we are in Southern California, and where Bo is in Nevada. Bo, I could be at your house if I left today at noon, I could be sitting in your living room at 3 in the afternoon if I flew, you know?
Yeah.
And that's the thing. It's so close for me to take a flight to Nevada. I mean, I have friends and we're big sports fans. You know, tonight is Game 5 of the Stanley Cup. For people to go from California to Las Vegas for a sporting event, I have people that do that all the time. You know, they leave on a 1 o'clock flight. They're sitting in the lobby of Caesars by 3:30 in the afternoon, you know?
Yeah, that's what I liked about it, that I can be in Orange County or San Diego very quickly. It's an easy drive. You just don't leave on a Friday or a Monday.
Yeah.
It's a quick flight. And our economy here too is getting diversified too. We've got not just hospitality. I mean, in 2007, I owned a bunch of real estate all throughout Nevada. I was in my 20s. I was young and dumb, and wasn't expecting, that 2007 and 8 crash. Like that was, one of the biggest crashes in the history of our civilization, probably, or financial civilization. I mean, it knocked out huge banks. I mean, it just was ugly. But I always knew that I always liked Nevada, and it's good to see this Las Vegas market getting more job growth and so forth. But I would say that we're more of a frothy market than like a San Diego, meaning like, we're going to probably see more of a slowdown here than you will in San Diego. I think our inventory, I'm going to closely watch our housing inventory, because that's like the first sign. I think once you start, we had very low inventory, and now I think it's crept up like 30 or 40%. So I think over the next, I was just listening to another guy that's been an agent out here for 20 years, and he thinks that we're going to be, he believes we'll be in a pretty decent downturn in the next, like he'll say, in the next 30 days, you're going to see a lot of negative news come out. It's going to put kind of fear in the streets, right? Because a lot of it is, it seems to me that a lot of things that we see, it become the fear mongering, and then the average person just starts seeing all the negative news, and nobody starts spending money, and it kind of puts us in a little bit of a tailspin, right? Like it's more of a, people kind of get scared, I think, and when people aren't spending money, what happens, right? Like the economy just slows down.
Totally. So what do you think, Bo, if you don't mind, as far as the question, so what do you think is going to happen in your being a lender? What are you seeing the disconnect between cap rates and, valuations and stuff? Do you think there's going to be kind of an across the board valuation from the lenders that they're going to, that people are going to have to lower their prices to adjust for rising cap rates? Do you see cap rates rising pretty quickly? Like you were saying, in this next month or this next 3 months, that's what I'm wondering is, in the short term, when are we going to start to see the effects of this? I'd like to hear that from you, because right now it's weird. We're still looking at deals here, and everybody is pausing. So there's definitely like a slowdown, or people are going, whoa, wait a minute. I mean, if my cost of debt is, 5 or 4.75 or 5.25 even, and this is on like 10-year fixed apartment debt, why would I pay a 4 cap or a 4.5 cap, right? And so that's what I'm wondering is, when are we going to see cap rate adjustments and pricing adjustments?
My friend is a big multifamily syndicator. He bought in Austin about a year and a half ago. It was like a $36 million multifamily property. And like in a year and a half, I think he's selling it, and he's getting $63 million, I think. And I don't know how much of that is it. And I think the point is, the majority of that is just like the insanity of the market. Like, I don't think that's definitely not sustainable. It's definitely like people are being overly aggressive in my mind. I don't know if he sold that yet or not, if it's still in, but I think, when there's an issue there of people overpaying. There's a lot, there's a million new syndicators. I've interviewed a lot of, everybody's a multifamily syndicator now. And so I do think there's a little bit of issues in that space. We all talk about this housing shortage, and it's kind of evident that it's true right now. Like across San Diego, we have no vacancy. So I mean so it's like the signs are contradicting to what I see.
Yeah.
And I have a lot of friends that are very, very successful, and it's like, okay, like, some of them are very, very bullish. Some of them are like, hey, hoard cash right now. This guy I know this guy I know just he's net worth of 100 million plus. That's his thing, and so I'm going to listen to him. He's going to talk for a small group of us, and like, I want to listen to guys that are worth $100 million, what to do. And so I think really house prices, not so much multifamily, is going to get hit because I think the average home buyer is not, they're not able to buy anymore. And then like me, I have 3% money. If I want to upgrade my house and move to a bigger or nicer property, I'm not only paying more for a property, but I'm paying 6% interest. So there's not
same thing.
So what I predict is not so much a pricing crash, but a transaction crash. So we're going to go from let's just talk residential because it's easier. You're going to go from X amount of units being sold monthly to like a 40% or 50% difference in transactions year over year. So that's what I think is going to happen. Which the trickle down effect then is what's going to happen. The people that were making tons of money, like my mortgage broker friends, my residential mortgage broker friends, they're making, their average year they're making 200 grand. This last couple of years they're making 500 and 600 grand a year. So those people are going to go back to making 150, right? So they're going to suffer. They're not going to be spending money because they go out and buy their new Mercedes and so forth. So I do think there'll be a trickle down effect. I think markets like Vegas, which are more cyclical than most markets, will probably get hit more. You're starting to see more price reductions. And I just can't tell. And I have the fear of 2007 ingrained in me because I got, I was a young guy and I was off to a good start and I got kind of my butt handed to me. So it always put kind of that fear in my mind versus my friends that started investing in 2010. All they've seen is appreciation and growth. They don't understand retraction. And so I just don't know the extent of it. And from the lending space, I do a lot of bridge money. So I do SBA bridge and some agency debt. But I think the people that went into bridge underwrote their deals with bridge debt, and then the expectations of getting 3% takeout multifamily, and now it's going to be 5%. I think they're going to have
in trouble.
Yeah, I think they're not. They're going to have a shortfall. So I do think that some of the greener syndicators, like a lot of people, I see the persona of a lot of people that they can't lose, and that's what scares me. That's because it's always good to have 6 to 12 months of reserves for everybody, right? Like we all need reserves because we just don't know when there's going to be, first of all, we don't know when there's a buying opportunity. I think now more than ever is the time to based on what my wealthy friends are saying is, get every available credit line ready, just be ready, whether it is a big downturn or not, that we're just prepared to take advantage of the situation. Because the worst thing that can happen is, if I was in a position in 2009, I could have, crushed it, right? But unfortunately, it took me to like 2013 to pick my butt off the ground. And I think now I'm a lot well versed in real estate investing, and the bottom line is if you have cash flowing assets, you're not going to go anywhere. It's the people that are over leveraged that are doing the Airbnbs, looking at last year because they went from $80,000 in gross revenue, and then during COVID they were making 140, and now they're buying expecting to get that 140,000. So I think there'll be slight setbacks in different markets. It's really hard to have a crystal ball. I mean, and I listened to what his name, Patrick Dan Bett. He's he owns large insurance companies, but he's like in one of his podcasts, he's like, he expects a 20 to 40% decline in home prices nationally, which I kind of find a little bit hard to believe because that would put us back into like a 2007 or 8. And then you have people.
I just don't see this like 2008.
I don't see it as 2008. You know why? Because we had to actually qualify for the loans. In 2000,
that's just it. The fundamentals are so much better now than they were then. But go ahead. What else did he say though? What did he say as far as So that he's thinking that kind of an adjustment. He's thinking like 40%.
He said 20 to 40%. So, but
Yeah.
that would be like frothy markets. Like I think like look at the Smoky Mountains. People were buying cabins 5 years ago there for 500 grand or 400 grand, and now they're 1 million, 1.1 million, 1.2 million. Like, to me, that just doesn't make sense. And it's because all these people said, oh, well, it's the number one tourist destination. And I have a lot of friends that invest in the Smoky Mountains. And like, I was like, man, these guys are crushing it. But then I really think about it, like, is that really sustainable if you're buying something for $1.1 million or $1.2 million? A lot of these new loans that are out there, we call them DSCR loans. So you can buy these Airbnb properties based on cash flow projections. So they'll
Yeah,
pull
so
up.
you're doing a debt coverage ratio. Is that what you're using?
Yeah, and they'll do it as a projection base. So there's like three, and so those loan programs are going to get. I already know.
Crushed, right?
Right. They're going to just off the bat. They're going to start lowering loan to value and everything. So they're. So those programs. So these large buyers of DSCR loans. So you don't need any personal income information. It's just based on the
You're
survey.
just going off the projections of the property, just the underwriting of the real estate, right?
Yeah. So I think those type of loans will get hammered, meaning that like the end buyers that are buying these in the secondary market, because years ago they didn't have a secondary market for fix and flip loans and the DSCR loans. And now these big institutional lenders came in, and it's like a night and day difference. You got like the lending homes of the world; they're doing 500 million per month in bridge and DSCR loans right now, and they're one of the biggest kind of bridge lenders. So all these emerging companies come out. So I think they're all gonna, because the buyers in the secondary market are gonna constrict. I think they're gonna constrict big time. I think there'll be some mergers in that field. I think there'll be definitely some of those companies that will slow down, and it won't be so prevalent. And the DSCR loans went from 4.5% 3 months ago on a 30-year rental loan. Now they're about 6.875. I just priced one.
I was gonna say pushing 7. Yeah.
I just priced one for the lady wanted to refinance a triplex, and I priced it out. And it was 8% for a 30-year. No, what was it? It was no, it was 7% for a 30-year fixed on a DSCR loan.
On a triplex.
Yeah.
Wow.
Yeah. So
now, is she using that triplex though? Is that only vacation rental income that she has on that?
No,
or is that actual long-term leases? Are those 1-year leases?
Yeah, that's a long-term. So the nice thing is she went in with a fix and flip loan. She renovated the triplex. She put tenants in. She created about 100 grand of equity, which is nice. And now she's like, well, I want to keep this. And a lot of these people have trouble going to the banks because the bank, like a commercial lender or a credit union on these small loans, they're going to look at your global cash flow. And a lot of these investors could never qualify from a global cash flow perspective. So that's why we use these DSCR loans, and but the rates have just gotten not that great. So that will slow down a lot of buying activity from the investor space. But I think there's always opportunities. I don't have a crystal ball, and I just think you have to be ready for different opportunities. But I think some of the really, really just all there is, it's in the middle of nowhere. It's just a tourist destination. And people just started buying crazy there. I think those people are going to get hurt.
I think you're right, and I follow you 100% on that. I agree with everything you said, and although I don't have the same experience that you do in the residential debt area, as far as like the bridge loans and things like that we've seen in apartments, so. I was telling you earlier, we have a sponsor that we work with very closely in the Southeast, and he's a great guy and has done just phenomenally well with the assets that we've gotten into. But his credo is, or his theory is, that he will not buy anything that he can't scale to, that doesn't scale to agency debt. So you as a lender understand that. So that means he's missing a lot of opportunities, right? Because a lot of guys only will use bridge debt. So in those heated markets like Nashville, Tennessee, and Atlanta, Georgia, there was a lot of bridge debt flying around. But he was like, look, if I'm not going to overpay for something that I can't buy. And we were looking at a deal, 240 doors, about 4 or 5 weeks ago. I want to say maybe 6 weeks ago. And he called me and was like, hey, we're trying to pursue this. And I'm like, well, what are you looking at price-wise? And he's like, well, they want a pretty heavy number. They want like $175,000 a door for it. And he's like, but my numbers, with the new interest rates, and he's got a very good agency lender in that market, and went to him. And he was like, we can only scale it to about $156 a door. And so I was like, well, are you going to make an offer? And he's like, I'll make an offer, but I don't think they'll take it. And so he made the offer. Of course, the brokers were like, come on, man, get out of here. And, we're giving him a hard time. And, and he just said, look, that's the best I can do. Well, here we are just 2 days ago or 3 days ago. What are we, Friday now? So on Monday or Tuesday of this week, I get a call from Kyle. And what's he telling me? Hey, man, those brokers called me from Nashville. And, we might be able to put that deal together again. Because, they're not getting, nobody's buying. The bridge debt's all gone. The $175K a door is now worth $156 apparently in that market. And, so there's definitely some adjustments going on. And I think those that have bridge debt on their real estate from a year or so ago, or maybe even 2 years, they're going to feel some pain when they step into the refi world.
Yeah, I have for smaller bridge deals, I mean, anything sub $10 million, I work with this lender. And so I always look at it like this. People call me and, hey, I'm looking at this apartment building. Okay, well, do you own any other apartments? No, I just own a bunch of fourplexes. Well, you need experience to get agency debt because, or you need to build somebody on your team that's got it and all this stuff. And then, obviously, occupancy might be in 85% occupancy. Well, you need 90%. So what I like to look at first is a bridge to agency product where they underwrite you for agency debt, but the property's not yet there. And so that's like that's like the top tier type of like anything small balance agency under 10 million bucks. I go there first because it's like, if you can get underwritten for the takeout up front, it's a lot easier. But then you get some of these but what I got this company, and they'll do 87% of purchase and 87% of CapEx. They'll do a 2-year term. So you're getting really high leverage. And as long as the gross loan amount does not exceed 75% of the stabilized value, they'll lend 87% of total project cost, which is pretty cool. I mean, the rates aren't great, but for the smaller operators, this is a really good program. As long as you really think and know your takeout situation, right? Because it's a 2-year term. You got to. A lot of times people just don't perform because of labor shortages and all this stuff that's going on, and then they get stuck, and then they have to extend, and they have paid default interest and things like that. And then I get the calls with these syndicators sometimes where like Fannie Mae is accelerating their loan because they're not, like, the occupancy levels dropped, right? Like that. I'll get a call like that every once in a while. Even one of my very experienced investors that owns $500 million in real estate, he had a same thing happen to him, and I got him a bridge loan to take out Fannie Mae because they were like pressing him to because they're nasty. They'll go. They don't care. They'll if you're not performing or the property's not performing, they'll accelerate the loan. They don't joke around at all. So I see that happening a little bit more lately. Because sometimes people go into a property, right? And what happens is they find out that, people aren't paying, and like what their rent rolls and T12 said wasn't really what's really going on. Because anytime you take over a property, as you know, being an experienced property manager, there's a lot that can happen. And there's, a lot of times there's stuff that doesn't get picked up in due diligence. And that's why you really want a good team that goes in and does the due diligence for you. If I ever get into doing bigger multifamily, I'm gonna, I know it really comes down to the property manager that's gonna be managing the property. At the end of the day, like, you can find the best asset in the world, but if you don't have the right property manager, you're done.
Yeah. Yeah, totally. And we have so it's interesting. When we get called, usually it's because of bad management, and so that's how we've picked up most of our larger owners. Is they're either done self-managing or they've just gone through a bad management experience. So we have seen that numerous times. And it is important, and it's also important to know, to know how to, build a relationship with an owner like that. It turns into a long-term thing. You become, kind of like you're part of their team. So that's an important thing to me. That's something that I really, I highly covet the relationships that I have with my owners.
Yeah.
Yeah.
And I'm sure in the future, like when you start the GP side up again and you find a really good opportunity, all these people know, like, and trust you. They're probably really want to invest in deals with you. Like, that's always an option. Not that you were thinking about it, but like, I'm probably thinking that all these people like to invest in real estate, and you've been managing their asset for 7 years, and now you bring them an opportunity, and they're like, because these people have money, and they want to. I think if I had a ton of money right now, I would just go out and I would invest as an LP with the best operators I could. I mean, if anybody's sitting there with a couple $1,000,000, you're better off. I mean, when I visualize like success to me is having my money working for me with the least amount of me thinking about it, and that's investing with good operators. So ultimately, to me it's better to be an LP as a professional LP than being a GP, because then you're not dealing with the stress of the property and the turnovers and like getting the property to perform. Right, like that's the stress of the GP, right? So I don't know, it's just
totally, and
yeah.
and that's something that's important. It's important to know who you're working with and what their experience level is. That's one of the things that we bring to the table, is because of our management background and because of our brokerage background and understanding both sides of it. We bring kind of an invaluable tool, and that is we really do understand how real estate runs. And, when you're with a sponsor, everything is real frothy and exciting when you're going into a deal, but you really do have to sit down and look at the reality of what they're underwriting for rent increases, for how they're moving the NOI and how the business is going to, remember, when you're buying an apartment building, at least apartment buildings that are at scale. So when I say that, I mean buildings that are 50 units or more. You're buying a business. You're buying an income stream that is going to be run by a multitude of people. And so you really do have to know what the plan is and how that's going to work, and we've looked at a lot more deals that we've turned down than we've done because of a number of different reasons. But usually it comes down to just not having the right operator or the right business plan in place that gives you a comfort level that it's going to run right.
Yeah, exactly. Well, I don't want to take. This conversation could go all day. You've brought so much value to our audience, and we really appreciate it. Robert, where can people find your? Can you give us the name of your podcast and the best place for people to follow you?
Yeah, so you can find our website at IPASD.com, which is Income Property Advisors San Diego, IPASD.com. Our podcast is the SoCal Real Estate Report. It drops every Thursday. It's usually similar to Bo's. It's just a quick market update. We talk about different topics. Danielle Wise in my office, we co-host that together, and then we do occasionally have some guests and things like that. So I may invite Bo to be on our podcast and talk about maybe some agency debt. We're located in San Diego, California. Our office address 4565 Ruffner Street, Suite 107, San Diego, California, 92111. And phone number is 858-279-1500. Feel free to reach out to me if anyone needs to have information about the San Diego real estate market.
Thank
Thanks
you
for
so-
having me, Bo.
Yeah, thank you so much. It was awesome. Everybody, I hope you enjoyed
Yeah.
this episode. We try to bring on guests from all different walks of life. You got a very experienced guest today that's got a wealth of knowledge from brokerage sales to property management to going in there and doing the turnover, the maintenance, everything. I mean, this was a really cool episode. So we'll see you on the next episode, everybody. Enjoy.
Thanks for having me.